Welcome to House Lux Estate, your home for insightful financial content. Today, we're diving into the captivating world of Forex trading. It's a market that has captured the hearts and minds of millions worldwide, promising the allure of high returns and the thrill of market fluctuations. However, as with any financial endeavor, the Forex market is not without its pitfalls. While it's true that Forex trading can potentially offer great returns, it's also a field where losses can be significant. It's a double-edged sword where the same factors that make it attractive can also lead to significant financial loss. So, why is it that many people lose money in Forex trading? Is it lack of knowledge, over-leveraging, or perhaps a lack of a solid strategy? In this video, we'll be dissecting these questions and shedding light on the common mistakes that often lead to losses. Today, we're going to delve into the reasons why many people lose money in Forex trading. One of the biggest mistakes in Forex trading is jumping in without the necessary knowledge. It's like trying to drive a car without first learning how to steer, accelerate, or brake. The road to successful Forex trading is paved with understanding. Without it, you're more likely to crash and burn than reach your destination. So, what does this understanding entail? Well, we're talking about understanding the Forex market itself, the terms used, the strategies that can be employed, and the multitude of factors that can affect currency values. It's a lot, yes, but it's essential. Let's start with understanding the Forex market. It's a global marketplace where currencies are traded. It operates 24 hours a day, 5 days a week, and it's incredibly volatile. This volatility can be a trader's best friend or worst enemy, depending on their knowledge and understanding. Next, we have Forex terms. Pips, lots, leverage, margin, these aren't just random words. They're crucial elements of Forex trading. A pip, for instance, is the smallest price move that a given exchange rate can make. Understanding such terms is like learning the language of Forex. Without it, you're essentially mute and deaf in a world that's buzzing with conversation. Then, there are strategies. Just as in a game of chess, you need a strategy to succeed in Forex trading. Whether it's scalping, day trading, swing trading, or position trading, every strategy has its pros and cons. And it's important to understand these before making your move. Lastly, there are the different factors that can affect currency values. Economic news, political events, market sentiment, these can all cause currency values to fluctuate. Being aware of these factors and understanding how they can affect your trades is a vital part of Forex trading. Without a solid understanding of these elements, you're essentially gambling, not trading. So, invest time in learning. Equip yourself with knowledge. It's your best weapon in the volatile, high-stakes world of Forex trading. Next, let's talk about over-leveraging, a common pitfall that can lead to significant losses. Now, you might be wondering, what is leveraging? In the world of Forex trading, leverage is essentially borrowed capital. It's like a loan given to you by your broker, allowing you to open larger positions than your account balance would ordinarily permit. When used correctly, leverage can amplify your profits, but it's a double-edged sword. It can also amplify your losses. Imagine this scenario. You have $1,000 in your trading account. With leverage of 100 to 1, you can open a position worth $100,000. Sounds exciting, right? But here's the catch. For every pip the market moves in your favor, you stand to gain a significant amount. However, for every pip it moves against you, you stand to lose just as much. This is where the concept of over-leveraging comes into play. Over-leveraging happens when a trader uses excessive leverage, opening positions that are too large compared to their account balance. It's akin to betting all your chips on one hand in poker. Sure, you might win big, but you might also lose everything. The danger of over-leveraging is that it leaves you vulnerable to market volatility. Forex markets are notoriously unpredictable. They can swing wildly in one direction, then in the other, all within a matter of minutes. If you're over-leveraged and the market moves against you, you can end up losing far more than your initial investment. So why do traders over-leverage? Often, it's due to a combination of greed and overconfidence. The prospect of making substantial profits can be tantalizing. But remember, the higher the leverage, the higher the risk. It's important to understand that trading isn't about making as much money as quickly as possible. It's about managing risk and preserving your capital. Successful traders know this. They use leverage judiciously, never risking more than they can afford to lose. Remember, high leverage can lead to high losses. It's not about how much you can earn, but how much you can lose. Another major mistake is trading without a strategy or failing to stick to one. Now, let's delve into that. Picture this. You're out on open water, sailing to a distant land. You wouldn't just set sail without a map and compass, would you? Trading in the Forex market is much like that. A well-thought-out trading strategy is your map and compass, guiding you through the turbulent sea of market volatility. A trading strategy isn't just about when to buy and when to sell. It's a comprehensive plan that outlines your financial goals, risk tolerance, and specific criteria that should be met for entering or exiting a trade. Just as a sailor wouldn't change course based on a gust of wind, a trader shouldn't deviate from their strategy based on momentary market fluctuations. Now, you might be thinking, well, that sounds straightforward enough. I'll just make a plan and stick to it. But here's the catch. The Forex market, much like the sea, can be unpredictable, and it's all too easy to let emotions take the helm. Fear and greed are the two notorious villains in this story. They can cloud your judgment, convincing you to abandon your strategy at the most critical moments. That's where discipline comes in. You see, discipline is the anchor that keeps your ship steady amidst the storm. Finally, one of the most dangerous pitfalls in Forex trading is ignoring risk management. But what exactly is risk management? In the simplest terms, risk management is the practice of identifying potential risks in advance, analyzing them, and taking precautionary steps to reduce your risk. In the world of Forex trading, risk management is your safety net. It's the measures you take to prevent your account from taking a significant hit when trades don't go as planned. Now, why is risk management so crucial for long-term success in trading? Imagine you're a tightrope walker. You wouldn't dare cross the rope without a safety net below, would you? The same principle applies to Forex trading. The market is unpredictable and can sway in any direction, like that rope high up in the air. Without proper risk management, you're risking it all on a single misstep. One of the most common and effective risk management techniques is setting stop-loss orders. Think of a stop-loss order as your personal bodyguard, there to step in when things get too risky. When you place a stop-loss order, you're instructing your broker to sell a security when it reaches a specific price. This way, even if a trade doesn't go as planned, your stop-loss order can limit the damage and prevent your account from taking a substantial hit. However, setting stop-loss orders is not enough. It's also crucial to determine the amount of risk you can afford per trade, often expressed as a percentage of your trading capital. A common rule is not to risk more than 1 to 2% of your account on a single trade. This way, even if a trade goes south, you'll live to trade another day. Ignoring risk management is like driving a car without a seatbelt. It might be fine for a while, but when things go wrong, the consequences can be disastrous. In Forex trading, those consequences can mean losing a significant portion, if not all, of your trading capital. So remember, always buckle up and manage your risks before you hit the trading highway. So those are some of the common mistakes and pitfalls in Forex trading. Let's take a moment to recap the key points we've discussed. First, we highlighted the importance of having a deep understanding of the market. Without this knowledge, navigating the complexities of Forex trading can be like attempting to cross an ocean without a compass. Next, we talked about the dangers of over-leveraging. It's enticing to use leverage to amplify profits, but remember, it can also magnify losses. We then delved into the need for a well-crafted strategy and the discipline to stick to it. Without these elements, trading can quickly devolve into a game of chance. Lastly, we stressed the crucial role of risk management. It's not just about making profits, it's equally vital to protect what you already have. Remember, success in Forex trading doesn't come overnight. It requires knowledge, strategy, discipline, and risk management. And as always, thanks for tuning into House Lux Estate. Don't forget to subscribe for more insightful financial content.